Hello and welcome. This is Kathleen Lobito, and I will be your host for today's webinar entitled VA IRRL, Everything You Need to Know. Joining me today is Kevin Iuppa, Military Mortgage Advisor with AAFMAA Mortgage Services LLC. He will be sharing just about 30 minutes of slides with you today. At the end of the presentation, Kevin will be able to answer any questions you might have. Although, if you have a question at any time during the presentation, feel free to type in your question into the comment box, and we can answer it at the end of the presentation. This monthly webinar is brought to you by AAFMAA Mortgage Services LLC, also known as AMS. AMS provides mortgages exclusively to the military community to build, buy, or refinance your home. This educational webinar seeks to provide AAFMAA members more information about the VA IRRL mortgage product. Without further ado, here's Kevin Iuppa.
Thank you very much, Kathleen, for the warm welcome. Thank you to everyone we have on the call today. Very much appreciate you taking time out of your busy day to join us to cover the VA interest rate reduction refinance loan and everything you need to know. Throughout the presentation today, I'm going to be referring to this loan program not by its very long name, but by the company acronym, which is IRRL. It's the way we refer to it here as a lender, and across the board with all lenders, that's how you're going to typically hear it referred to. So without any other notes before we start here, on your first slide, you will see who is AAFMAA Mortgage Services LLC. So AAFMAA Mortgage Services is the mortgage division of AAFMAA. We've been around for about 3 years now, and in terms of what we do here, our job is to help our AAFMAA members obtain all the information and support they need to get the best possible financing for home purchases, construction, and refinances. And our commitment is to make sure you, as part of the military community, are well informed and taken care of at every step of the lending process. Plus, as being part of the longest standing non-for-profit member-owned association enables us to offer low rate and low cost mortgages to service members and veterans. In terms of what we are going to be covering for you today, you'll see there the agenda slide. We're going to start with the benefits of a VA IRRL. Moving forward, we're going to cover the requirements and documentation you want to be aware of, the process and timetable, and as well as the cost-benefit comparison, which is, in my opinion, the most important aspect when looking at whether or not doing a VA IRRL would be the right fit for you and provide the benefit that you'd be looking for. Jumping right into things here, the benefits of a VA IRRL. So the VA IRRL is a great loan program. It's one of the easiest and most straightforward ways to refinance a VA loan. In terms of the obvious benefits is a lower interest rate. A lower interest rate would correlate to a lower monthly payment. Another benefit would be the ability to pay the loan off faster. And what I mean by that is when you achieve savings by doing this transaction, you free up cash flow, which you could then use to put back towards your mortgage on a monthly or yearly basis to knock down that principal balance and get the loan paid off faster. Very simply, the faster you pay off your loan, the less interest total you will pay to own that home outright and knock out the mortgage. Beyond that, there are no out-of-pocket expenses that you incur to complete this transaction. That isn't to say that there aren't any costs involved, because there are always costs involved with any refinance, but the beauty of the VA IRRL is that you can roll those closing costs right back into your new loan, so you don't have to cover those out of pocket. A couple other quick benefits I wanted to mention that aren't represented on the slide is the fact that when you complete a VA IRRL, you can skip mortgage payments, up to 2 mortgage payments, depending on when you close on the loan. So it's not represented on the slides because it's not necessarily a huge benefit that a lot of borrowers look at when taking a look at whether or not they want to do a VA IRRL, but it certainly can be something that helps you out in terms of short-term increase in cash flow. Beyond that, on the same topic of short-term increase in cash flow, you will receive a refund from your current lender for the balance of your escrow account once that loan is paid off. So, between skipping 1 or 2 months and getting the balance of your current escrow account back, you can actually see quite a large short-term cash flow hitting your pocket when doing a VA IRRRL. So those are just some of the major highlights and benefits of the VA IRRRL refinance. And obviously, as you can see, the underlying theme here is doing this sort of transactions offers you, the borrower, savings. In terms of what to expect for a VA IRRRL and the requirements, the number one requirement is that you cannot be late on your mortgage within the last 12 months. And I want to elaborate on that word late. When I say late, I do not mean you make your mortgage payment on the 16th instead of the 1st and you get a late fee from your current lender. That is not what I'm referring to when I'm saying late. For mortgage purposes, being late on your mortgage means that you have not made your mortgage payment within the month that it's due. As long as you make it within the month that it's due, even if you incur a late fee from your lender, you are not reported late to the credit bureau, and that would not impede you from moving forward and completing this transaction. One other requirement that I wanted to touch on that we don't have on the slide there is that in order to do a VA IRRRL, you have to currently be on a VA loan. You can do a VA refinance from a conventional or FHA loan over to the VA platform, but in order to do the specific VA IRRRL, you do currently have to be on a VA loan. In terms of some of the other requirements, the current primary borrower on the VA loan, the veteran or service member, must remain the primary borrower on the new loan. Beyond that, there is a net benefit requirement in order for the lender to be able to offer you the option to do the refinance. And essentially what I mean by net benefit is we must reduce the monthly payment by a large enough amount that you can recoup your closing costs within 36 months. It's kind of wordy, so let me give you a quick example. If you take a look at doing a VA IRRRL and your monthly savings is $100 per month and the closing cost to complete the transaction is $1,000, some quick math will tell you that you recoup those costs within 10 months, and that is within the 36-month recoupment requirement time frame. So that would be a situation where we could offer you that transaction because you're recouping those costs within the required time frame. Beyond that, the maximum amount you can receive back at closing is set at $500. So you can roll in your closing costs. You can also roll in the deposit for taxes and insurances into your new escrow account, which I like to just refer to it as your little piggy bank for taxes and insurances that your lender holds onto. You do need to fund that when you obtain the new loan. You will get the refund for the funds in your current escrow account with your current lender back after closing. And as I mentioned before, the max cash back at the actual table is capped at $500. So this isn't the type of transaction that you would complete to get $20,000 out to make home improvements or pay off debts. This is very simply a rate and term refinance, and that's why the cap is $500 on the amount you can receive back at closing. Moving right along, what to expect, some of the features of a VA IRRRL. This is where we really dive into how simple, straightforward, and streamlined this product really is. You don't have to jump through all of the painful hoops that we're all very familiar with when it comes to doing a mortgage transaction. There is no appraisal required for a VA IRRRL, so the value of your home is not taken into account. With that not being taken into account, the correlation is there's no cap on loan to value. And again, the idea very simply is you can roll in the cost to complete the transaction and the prepaid items for taxes and insurances insurance being deposited into your new escrow account, and there's no comparison against the value of your home to do that. Beyond that, there's no income verification, so we're not going to be obtaining pay stubs and W-2s and all of that fun stuff. It's not required for this loan, and again, that correlates to no debt to income evaluation. So we're not going to be taking a look at how much income you have on a monthly basis and how much debts, and making sure you stay under the typical 45 to 50% cap. We don't take a look at any of that. So again, just makes things more straightforward, less documentation, easier to qualify and get the loan done. There are no pest inspections, well water test, or septic system inspections required for this transaction. And in terms of the credit report, we can even obtain a mitigated credit report that only provides us information on your mortgage trade lines. So that's, again, just another benefit of it being such a simple, straightforward process. Even a more simple, straightforward credit report is obtained. in terms of what to expect documentation-wise. So typically the first document obtained, one of the most important, is going to be we need to confirm your VA loan eligibility. The way we do that is by obtaining a certificate of eligibility. That is something that we, the lender here at AAFMAA, will obtain for you. In order to obtain the COE, certificate of eligibility, we need either a DD-214 or a current statement of service, and most of the time we will obtain that for you as well if you don't have it readily available to send over. So we can take care of all of that for you, obviously, with AAFMAA being focused solely on the military and service community. We're very familiar with obtaining these documents and do it for almost all of our borrowers just to make things easier, one less thing for you as the borrower to worry about providing. Beyond that, the other very simple, straightforward documents needed is a copy of your government-issued ID and Social Security card, a copy of your most recent mortgage statement, a copy of your current mortgage note. That one tends to be one borrowers aren't super familiar with. So just to expand on that, the mortgage note is your promissory note to repay the loan, and you would have received that at the closing on the current loan that you have. And if you don't have that readily available or aren't able to locate it, you can always contact your current lender and they will provide you a copy of your mortgage note. Beyond that, we're going to be looking for a copy of your homeowner's insurance policy. And the last one here, most recent property tax bill, I added that because I like to obtain that just to make sure when I'm working up the figures for you, I have everything as accurate as possible. But technically, if you don't have that readily available, we do not need to obtain that from you. We can obtain that later in the process through the title company when they obtain all of the property tax information. In terms of the process, so how would this transaction work? The first step is to determine your eligibility and financing options. So that's where we're going to sit down and take a look at, what amount you're looking to refinance, where your property is located, all those good things, credit. Just so you're aware, the minimum required credit score to complete this transaction is 580. So again, very lenient on that end of the spectrum in terms of allowing for lower credit scores to be eligible to complete the transaction. So once you've taken a look at your eligibility, take a look at your financing options. So run down, a couple different scenarios, as many as you would like to see or evaluate, and then provide you all those details, discuss things, and you, the borrower, of course, make the decision. We're here to support you and guide you, but at the end of the day, this is your loan, and we will do whatever it is you prefer in terms of what you feel is best suited for you and will offer you the best benefit moving forward. From there, we're going to look to lock in your interest rate to make sure that that interest rate is guaranteed through the date you close. At this point, you'll be provided electronic disclosures, which you would just very simply click sign, and you would provide any additional documents needed for loan approval. Once we have all that information in from you, the loan will be submitted to underwriting. The underwriter would review the loan, and we would obtain the loan approval. And from there, if there are any final items needed to clear the loan for closing, we would obtain those. But at that point, we're pretty much done. It's a very simple, straightforward process. We would come back to you, let you know your loan is cleared to close, and find out what date you would like to schedule the closing for. Again, simplicity, ease. When it comes to closing, we can have a notary come right out to your home or any other location that's most convenient for you, so you don't have to go anywhere. You can close right in the comfort of your own home. And at that point, you're done with the transaction. So again, it's very simple, straightforward. The average turnaround time to complete a VA IRRL is less than 30 days. It can be significantly shorter turnaround time than that. It really is just a matter of how quickly you provide the information we need to move your loan forward throughout these different steps of the process. In terms of, as I mentioned before, in my opinion, the most important aspect to taking a look at doing this transaction is the cost-benefit comparison. And what I mean by that is everyone wants to save money. Reducing your monthly mortgage payment, saving $100 a month, obviously everyone loves that, but how much you save is you're only really able to determine the tangible benefit of that when you compare it to the costs that you incurred through the transaction, essentially the cost that you've incurred to obtain those savings. And the first thing we look at when evaluating this comparison is your break-even time frame on closing costs. Again, I'll use the example I mentioned earlier. If you're saving $100 a month and it costs you $1,000 to do the transaction, within 10 months, you've broken even. You've recouped the $1,000 you spent, saving $100 for the first 10 months on that loan. And so every single month after that, you are going to be really feeling the benefit of this transaction with that $100 savings after the recoupment of your closing costs. From there, we want to take a look at the anticipated savings over the remaining period of time on the loan. And the reason why that's a very important aspect is doing this type of transaction, it's not always equal for each borrower. And what I mean by that, if someone's going to do this transaction and they're going to be in the home for the next 30 years, well, they're obviously going to have a significant amount of time on that loan. So they'll have more time for all those months of savings to add up, and they're really going to feel that benefit. It's going to be a larger benefit for them because they have more months of savings before that loan is paid off. On the other hand, if you have someone that's only going to be in the home for the next 2 years, well, there still could be a benefit for them, but that's where we need to take a closer look at how long you anticipate to be on that loan to really determine, okay, how long till you break even, and then how many months of savings are you going to have on this loan before you either sell the home, refinance, or pay the loan off. So it's a very important aspect to analyze the anticipated savings over the remaining period of time on the loan. And to expand on that a little bit here, what I've done is provided you with an example. So this example I just pulled based on an average loan amount in the state of Virginia. And what you will see here, I chose Virginia because the closing costs in Virginia are pretty much middle of the road. They're not the highest, they're not the cheapest across all the states that we originate loans in. So I thought it was a good middle of the road example for you guys. And in this example, what you'll see is that the current mortgage has a payoff of $300,000. So you got a loan, the payoff to pay that loan off with your current lender is $300,000. The rate that you have on your current loan is 5%. The correlating principal and interest on that loan you're currently on is $16.1046 per month. Now, when you take a look at the VA IRRRL option, the new loan amount will be set at $300,000. The rate would be 3.5%, and the principal and interest for a loan of $300,000 at a rate of 3.5% is $1,347.13. So if you direct your eyes down there to that red box you see, the monthly savings doing this transaction is $263.33 per month. It's an awesome savings to achieve doing a transaction like this. The closing costs are estimated at $3,100. So when you divide the savings into the closing costs, you see that your break-even time frame on those closing costs is 12 months. So 12 months in, you recouped your $3,100. You're in the green moving forward. And the total savings then over the remaining term of the loan, so a 30-year loan is 360 total payments. If it takes you 12 payments to break even, that means you have 348 payments left on the loan, saving $263.33 per month, equals those total savings you see there at the bottom of $91,638. And that's really, the purpose of this transaction, a very simple, straightforward, easy transaction that's designed to benefit VA borrowers and achieve overall savings. Obviously, not too many people out there are going to turn up their nose to saving $91,000 on their mortgage. It's a great way to reduce the cost to own that home outright. So it's a really, really great program. I'm a huge fan of it. It's one of my favorite loans to do. With all of that being said, I want to open it up to you guys at this point to field some of your questions so that I can elaborate more on what specifically you guys want to know. So we have a question here. Let me just take a look. The question is, we have a conventional loan. So we need to take step one, switch to a VA loan, and then apply for a VA IRRRL. It's a good question. Realistically, you wouldn't want to do that. A couple reasons why. It would depend on your state. And what I mean by that is some states are cheaper closing costs-wise. And the reason why that's important is because if you do a refinance from a conventional to a VA, you're paying closing costs to do that refinance. And then to do another refinance on a VA IRRRL over to a new VA loan, you're paying closing costs again. It just typically doesn't make a whole lot of sense to go through two transactions like that. Typically what we would do is just do a straightforward normal refinance from your conventional loan over to the VA loan. In terms of interest rate, the interest rates are going to be right about the same as what you would see on a VA IRRRL. The only downside to doing it this way is that you are applicable to all the normal requirements to qualify. And what I mean by that is income verification, appraisal, all those typical requirements that you don't have on a VA IRRRL would be applicable. But at the end of the day, as long as those requirements don't represent an issue for you, then that would be my recommendation. You just go straight from conventional to VA. That's the easiest way to do it, and that's what's going to get you to the lowest interest rate and those monthly savings you're looking for as quickly as possible. Realistically, even in this scenario, the closing costs from a conventional to a VA loan really aren't that much higher. The only real difference in terms of closing costs doing a conventional to the VA refinance is that you have the appraisal fee, which is typically about $600 depending on your state. So that's really the only increase in the closing costs to do a conventional to VA refinance as opposed to the VA IRRRL refinance we've been discussing. See what other questions you guys got for me here. Does a VA IRRRL require escrow of taxes and insurances, or can I pay my taxes and insurances myself? So VA loans are one of the few loan programs out there. VA and FHA are the only two that require that you escrow taxes and insurances. It doesn't matter how much equity you have in the home. That's not taken into account as it is on a conventional loan. So yes, you are required to have an escrow account for taxes and insurances. And I know a lot of people would prefer to just hold on to their money and pay their taxes and insurances throughout the year when they're due themselves. I can certainly understand that that view on things. But what you want to keep in mind here is, at the end of the day, you will never pay more taxes than your county requires you to pay. You will never pay more homeowners insurance than your current homeowners insurance company requires you to pay. And mortgage companies are required twice a year to do an escrow review. And what that entails is they take a look at your account, they take a look at how much you are due to pay out for homeowners insurance and taxes the next time they become due, and they check to make sure that they are not over collecting taxes and insurances into that escrow account. So basically, it's a double check they do twice a year. If they are over collecting, they are required to refund you the difference. And guys, the very simple idea behind this is, yeah, it can be a little bit of a pain in the butt to fund the escrow account, and when you're doing this refinance, you get a refund from your other lender. It's not as clean, cut as we would all like it to be, but at the end of the day, it's really one of the only possible drawbacks to doing a transaction like this, and the savings and ease of the transaction far outweigh the downside of not being able to pay your taxes and insurances yourself and having to do the escrow. But that's pretty much the long and short with regards to that requirement for the VA IRRRL. Looks like we got some other questions coming in here. Let's see what we got. If you've owned a home for only 6 months, if I refi, I only plan to be in the home for a few years. Okay, so essentially the question here is, I purchased a home 6 months ago. I'm only planning to be here for 2 years. Does it make sense for me to do a VA IRRRL? Answering that question, there's a couple different aspects that need to be analyzed. Number one is what state your home's located in, because again, the cost to complete a transaction, whether it's a purchase or refinance, they do vary drastically between states. So if you're in a state where the closing costs are lower, then it may be more feasible for you to do that, even though you're not going to be on the new loan for all that long. In a state where the closing costs are higher, that is something that would probably make it more difficult for you to see a tangible benefit in completing an IRRRL refinance. And when I say closing costs differ by state, essentially what I'm referring to is the transfer taxes or deed taxes that you pay when you're doing a refinance. It's essentially that local county where your home's located in, it's their sales tax on you obtaining the new mortgage. So that is what differs so drastically from one county to the next throughout our country. And so in terms of should I refi and do an IRRRL 6 months in when I know I'm not going to be there for more than another 2 years, it would also depend on what interest rate you currently have. If you got a loan 6 months ago, my guess is that you probably got a pretty darn good rate as it stands. So it would be one of those situations where I'd have to run all the numbers, determine, what your current rate is, what your current principal and interest is, how much the transaction would cost, how much you could save monthly, when you would break even, and then once you've broken even, how many months are you going to actually have where you're going to feel those savings hit in your pocket before you're going to get off of that loan. My initial gut reaction would be, it seems like a lot of work for very small reward, but again, it just depends. For example, if you got $1 million loan, it may make more sense to do that because obviously every 1/8% you can drop your interest rate is a significant reduction in that payment on such a large loan. For someone on a smaller loan, every 1/8 reduction in your interest rate doesn't affect or reduce your monthly payment as much. So, those are the factors that we would need to take a look at in order to determine if it's the right fit for you. And that's a great question. That's exactly what we are here for. That is what my job is on a daily basis, to facilitate the success of our membership when it comes to mortgage financing. So anytime you guys have any questions like this, please pick up the phone, shoot an email. All my contact information is right there. More than happy to run down these scenarios with you, run the numbers, provide you the information, and go over what benefit you would receive and whether or not it's the best transaction for you to do at this time. All right, so let's see here. Got another question. If I already have a VA loan, does that constitute VA eligibility? Am I eligible for a VA IRRRL? And so essentially how VA eligibility works is as long as you have honorable discharge and you've spent enough time in the service to obtain VA eligibility, the only way that you lose VA eligibility is if, essentially the VA takes it from you. You have to do something wrong for that to happen. Some of the scenarios where, what I mean by do something wrong would be short sale a home. Basically, you owe $500,000, you can't make the payments any longer, you put it up on the market, you sell it for $450,000, leaving your current lender short $500,000 or $50,000 that you owed. That would be a situation where there's possibly would reduce some of your VA eligibility because you defaulted on the loan. Same thing would be with a foreclosure. A foreclosure is a similar idea. You can't afford the payments, but instead of selling the home for as much as you can get for it to satisfy at least part of your loan with your current lender, foreclosure is when you just walk away. You don't try and sell the home, you just walk away and give the home back to the lender, and then the lender has to deal with trying to sell that home to recoup the money that they had invested in that. Also possibly bankruptcy that includes a mortgage, a VA mortgage. Those are some of the scenarios where you can see borrowers losing some or all of their VA eligibility. Beyond that, when you obtain a VA loan, you use your VA eligibility. When you go to refinance that loan, you're going to be paying off your current loan. You get back to full VA eligibility, and that allows us to do the refinance using that VA eligibility that you essentially reobtained by paying off your current VA loan. So the very winded answer to your question here is yes. I don't think I've ever come across anyone that's currently on a VA loan that was not able or eligible to do a VA IRRRL. I can't really think of any scenario where you would lose VA eligibility while still currently on your VA loan. So long and short of it is yes, you certainly should have no issue with VA eligibility trying to do this transaction. All right, here, so it looks like this is the last question we have. The one thing I will say is, again, all my contact information is right there. We do want to keep this to about 30 minutes so you guys can get back to your afternoon. So if there's any questions that I didn't have a chance to address, by all means, shoot me an email, give me a phone call. Again, my email is K-I-U-P-P-A. It's often misspelled with an L. So my last name is Iuppa, like Italiano, Iuppa. And so you can contact me via email, or you can give me a phone call at any time. I'm here to help in any way I can if I haven't addressed your question throughout today's webinar. In terms of this question, what we got here is interest the same for everyone? What is the lowest available rate? So the answer to that, very straightforward, is no, absolutely not. Interest is not the same for everyone. When you guys see interest rates advertised, that is typically the interest rate for someone with optimal borrower criterion. And what I mean by that is high credit score, primary residence, detached single family. All of these different factors contribute to what interest rate you're going to receive. The higher your credit score is, the better interest rate you're going to receive. In terms of property type, If it's a primary residence, you're going to be looking at the highest or the best interest rates. If it's a second home, typically the rates aren't going to vary much, but they're in some cases a little bit higher. And then when it comes to an investment property, interest rates, you will see a reasonable difference between the rate you can get on a primary residence and an investment property. And very simply, the idea behind all of this is risk. If you live in the home, you're more likely to make sure to make your payments because you need some place to live, you need a roof over your head. The reason why interest rates are higher on investment properties is because if you fall on hard times, you're more likely to pay the mortgage for the place where you live because you need a place to live than the home that you're renting out. So that is why you will see interest rates fluctuate depending on the property usage in terms of primary, secondary can also be considered vacation and investment. And then the other major factor that you'll see is the type of property. And what I mean by that is it a single family detached home? Is it a townhouse? Is it a condo? And again, the reason why interest rates differ between these types of properties is very simply based on risk. Higher risk equals higher interest rate. And so the biggest change you'll see in interest rates is going from a single family home or townhouse. Honestly, there is really no difference between the interest rates you're going to see for those two types of properties. But when you shift over to a condo, you are going to see a higher interest rate. Typically, it's going to be about 1/8 to 1/4% higher. And again, it's just based on risk. When you got all these people stacked living on top and all around one another, you know, all it takes is someone having a bad day and overruns the tub and it leaks down to your building, and now you're dealing with water issues in your unit. So again, it's just based solely on the risk. And in a condo, there's more risk that something could go wrong, and that's just because you're surrounded by people on all sides. So that in general answers what you're looking for in terms of are interest rates the same for everyone. And then just to touch on the last part of her question here was what is the lowest rate available currently for a borrower with optimal criterion? The going rate for a 30-year fixed VA IRRRL is right about 3.25%, and that rate is available without spending any extra money to obtain it in the form of discount points. So that's the rate you would get, and you wouldn't be charged anything for that interest rate. So 3.25% is a great rate. That is about as low as I have ever seen interest rates on a 30-year mortgage, going all the way back to 2012. So this is really a prime time to go ahead and take a look at the benefit for yourself in doing one of these transactions because we do not know how long rates are going to hold at such historic lows. All right, guys. Well, with all of that being said, again, I just want to thank you so much for taking time out of your busy day to join us. I hope you found this beneficial. Two other things real quick before I let you go that I wanted to mention. Again, all my contact information is right there. Please don't hesitate to reach out. If there's anything I can do, even if you're already working with another lender and you'd like a second opinion, let me know. That's what I'm here for. Beyond that, we are going to be sending out a survey tomorrow with a series of questions. Please provide your feedback. The idea behind providing the survey is to find out what you guys liked about the presentation, what else I could have covered for you, what other topics you'd like me to cover, and then what times work best for you. We want to tweak these webinars to meet your needs and be at a time that's convenient for you. So that feedback is greatly appreciated, and we'll certainly use that to tweak things moving forward to make this as beneficial for you guys as humanly possible. So again, thank you so much for taking the time to join me today. I hope you guys have a great rest of your day and an even better weekend.